And we want to continue this important conversation as the Fed leaves rates unchanged. But the Wall Street Journal, we're getting all the headlines, open to another hike. Joining me right now, Andrew Brenner, head of international fixed income securities at Nat Alliance Securities. Your thoughts? Two in a row. Pause.
Nicole, I see a lot of interesting stuff here. First of all, thanks for having me. It's always a pleasure. I see some very unique stuff coming out of the headlines that the Fed seems to be more concerned about how high longer interest rates have gone and what the term premium is. And they mentioned it already twice. And I think that overwhelms their idea of raising rates again, as well as, inflation. And I really think this is the beginning. If this isn't the actual announcement, this is the beginning of a Fed pivot. So we're looking for significantly lower interest rates based on this. But of course, it'll all be dependent on how Powell moves at the press conference, if he moves left or if he moves right. But this tells me the Fed is much more concerned about how high long rates have gotten and what the real rates are. And they're very worried about that, which means they're going to try to temper that in such a way as to not give back, what they've done, but yet not send the economy into a recession.
Yeah, and to your point, the long-term run-up that we've seen in these rates and the Fed saying, of course, that really could weigh on economic activity and some of the projections going forward with inflation still coming down. At the same time, you have a very tight labor market, and consumer spending is something that is not giving up. It's, saying here, consumers boosted their spending briskly, and employers rapidly expanded payrolls. And so we're in not a terrible time here.
Nicole, it's the idea of looking backward or looking forward. Looking backward, the economy's been strong. We've had some very good numbers. Looking forward, things do not look as good.
Right.
And I'm still not calling for a recession, but I just saw as we were talking, the Atlanta fourth quarter GDP was just cut in half. So, I see that. I look at the Citibank numbers. What came out today is their credit card data is showing between 11 and 12% cutbacks. So I'm not so sure the consumer going forward is going to be as good as the consumer looking backward. And I think the Fed finally sees this. They're not driving, looking out the rearview mirror. They're looking out the front. And I think that's a good thing. And I really look for 5 years to get to 452, 2 years to get to 4 3/4, and 10 years to get to 450. Not today, but between now, tomorrow, and the unemployment number on Friday, if there's a surprise there, I really think we're going to have about a 25 basis point move lower in yields.
So you're comfortable with saying done? Fed's done?
The Fed is done, and done.
Can
I be more emphatic?
I tried to pitch it. You hit it out of the park. You got it right there. There's the soundbite. And that's what I was looking for, because at the same time, you bring up the point about those credit cards. And we've seen, when you look at the bar charts, you see everybody's using credit cards again. At rates, some of these credit card rates are above 20%.
22 is what I hear.
Yeah, and so they're doing this buy now, pay later, and it's going to snowball. And it's going to be tough, and if the economy slows down, I know I was talking about employers rapidly expanding, who they're hiring or wages and such, but it's still a very tough time, and people maybe should be a little more cautious. Should they be more cautious? Should they be saving their money? They have high rates and such.
I always think it makes sense to save money, but there are a lot of people in the country that go from paycheck to paycheck. And
a high percentage of people.
Very
do
high
that,
percentage,
right?
more than
1% or something.
Much more than I would think. But no, I think that things are going to slow down. I think things have to slow down, and I think as the government stimulus goes away. But the good thing is, on top of all this, the Treasury this morning came out with a much lower package of long-term issuance, which helped the market as well. So we're probably going to look at about a 15 basis point move in 10 years up to this point in time, and Powell hasn't even started yet.
At this point, I think it's important that we talk about what the Treasury auctions are doing. We know now that they're talking about the $112 billion in debt. That'll begin next week to do that. What did you think about the move? I think that a lot of folks felt that this was an overhang about how they will do that. The auctions have been received in different manners over the last few weeks. Some seem to have more demand than others. one actually, said he was concerned about it. What was his word? He said that the Treasury refunding was a bit disconcerting. What do you make of it? Why should people care?
I think the Treasury is oblivious to how things work on a day-to-day basis. They are the least opportunistic group I've ever seen. They had the opportunity, a year and a half ago to raise $1 trillion long bonds at 2%, and now it's going to cost them 5%. But they've never been like that. So I don't think today's move was anything to do like that, even though some say it was. I think the Treasury was looking just at tax revenues, and there are some idiosyncrasies coming out of California where they got a lot more revenues, so that they need a lot less money. I think it's more interesting, a story in Reuters this morning saying that the Fed is seriously considering ending QT when the reverse repos go to zero. I think that is very interesting because it's showing how liquidity is not as good as it has been. The Treasury auctions have they've come and gone. There's been good overseas demand. Non-directs are okay. There has been some leakage, in whatever, a little bit gap here and there. But I think overall, the Treasury can continue to issue. But there are less buyers. The Fed is no longer a buyer. Other central banks are buying, but there are problems in Japan. They've been well noted. The yen, it continues to get crushed versus the dollar. So that takes them out. And of course, U.S. banks have had nothing but massive losses in their held to maturity. I mean, Bank of America's losses announced last week were $139 billion, and that was before rates even went higher.
So as we talk about this, and by the way, right, Japan abandoned the yield control, basically, right? I mean, sort of
tweaked it. Yeah.
Tweaked it. Okay. Yeah. I wanted to talk about here at home. When you look at what goes forward here, as I got caught up on my Japan thought, but the big picture, I remember what I was saying, is like when you think about the bullets that the Fed has. I mean, they've been using the one tool a lot with raising rates very fast.
Very fast.
When you talk about the quantitative easing and tightening and running off that balance sheet, right? And so now that was the other tool. So basically, they're going to not use both tools? I mean, is that what you're saying? If they're not going to run
stop raising rates.
Stop raising rates.
Absolutely stop raising rates. They will lower rates much faster than people anticipate. Yeah. I think that they'll start lowering rates by June of next year. I think they'll probably end up lowering 4 times. I would expect the Fed to drop, I think the 10-year to drop to 3.5. All right. As far as QT goes, they're going to try and hold on to it as long as they can, but I think they're going to stop. QT is a little bit less than people anticipate because it's $60 billion of treasuries a month, but it's only about $15 billion of mortgages because that's all that's running off. So it's $75 billion a month. And of that $60 billion, when an old 30-year, which might even be a week old, goes off the books, they end up buying a new 30-year. So they're extending duration in a lot of what they're buying. So they're still helping the bond market out, but just not as much as they have in the past. So they're not going to be quantitatively easing anytime soon, at least not without a real banking crisis, which could happen. That is my black swan event. But of course, by definition, you can't predict black swan events. But banks are definitely in trouble. And you look at the bank index, the KBE index, I think banks are down 51% from their highs.
Right.
I mean, that's horrible.
Right. Well, the regional banks in particular.
Yes.
Unbelievable. Great conversation. Thank you so much. We
always
love
a pleasure.
When you're here. And 4 cuts starting June of next year. Very interesting. Andrew Brenner, love when he's able to be with us here of NAT Alliance Securities.